In line with the elaboration on the Keynesian model, presented momentarily, Keynes argued that the market economy is inherently unstable because of several interrelated factors. His critique challenged the classical view that markets are self-correcting and tend toward full employment, arguing instead that markets often fail to reach equilibrium and are prone to cycles of boom and bust. What are these interrelated factors? First, uncertainty. A central theme in Keynes' analysis of market instability is the role of uncertainty. Keynes distinguished between risk, where outcomes can be predicted with probability, and uncertainty, where the future is unknown and unpredictable. This distinction is crucial for understanding why markets are prone to instability. He coined the term fundamental uncertainty. Keynes argued that the future is inherently uncertain and economic actors cannot predict with confidence what will happen. In contrast to classical models, which assume rational decision-making based on known probabilities, Keynes emphasized that business and consumer decisions are often made in the face of radical uncertainty. What were the effects? Impact on investment. Investment decisions in particular are highly sensitive to uncertainty. Firms may delay or reduce investment if they are unsure about future profits or the broader economic environment. When uncertainty is high, businesses and consumers adopt a more cautious approach, leading to a drop in demand, lower output, and increased unemployment, as you heard in the previous video. In accordance with what was just stated, Keynes famously referred to animal spirits to describe the psychological and emotional factors that drive human behavior in the face of uncertainty. Confidence, fear, and optimism or pessimism can influence investment decisions on predictable ways, causing swings in economic activity. A sudden collapse in confidence can trigger recession, while over-optimism can fuel speculative bubbles. Keynes argued that this pervasive uncertainty is a key source of market instability because it can lead to erratic and unpredictable fluctuations in investment and demand. Another important role in the inherent stability assumption play expectations. Expectations about the future play a crucial role in Keynes' explanation of economic instability. Since economic actors make decisions today based on the expectations of future events, shifts in expectations can have a profound effect on economic outcomes. For example, self-fulfilling expectations. Keynes argued that expectations are often self-fulfilling. If firms expect low demand in the future, they will cut back on investment and production today, which leads to lower demand in the present, confirming their initial pessimism. This can create a vicious cycle where negative expectations about the future cause economic contraction in the present. What are the implications of self-fulfilling prophecies? Volatility of financial markets. Keynes also pointed out that financial markets are particularly prone to shifts in expectations. Investors often base their decisions not but on what they expect other investors to do. This leads to short-term speculation, increasing the volatility of asset prices and contributing to broader economic instability. In Keynes's view, because expectations are volatile and driven by psychological factors rather than just rational calculations, they introduce a high degree of instability into market economies. Expectations also affect how the interest rate mechanism operates. In classical economics, the interest rate is seen as a key factor in ensuring market equilibrium, balancing savings and investment. However, Keynes argued that interest rate mechanism is unreliable and insufficient to stabilize the economy. Here's why. Keynes introduced the concept of liquidity preference, arguing that people's desire to hold cash rather than invest or lend influences the interest rate. In times of economic uncertainty or pessimism, people prefer to hold on to money rather than invest, which can drive interest rates to extremely low levels without boosting investment or demand. Keynes believed that during a liquidity trap, even near zero interest rates may not stimulate investment, on the other hand, because firms and individuals are too pessimistic about the future. This leads to a situation where monetary policy That means lowering interest rates becomes ineffective as people hoard cash instead of spending or investing. This can contribute to prolonged periods of economic stagnation or recession, as the interest rate mechanism fails to restore full employment. Accordingly, investment is driven by expectations. Investment decisions depend not just on the cost of borrowing, but also on expectations of future returns. If businesses expect low demand or economic instability, they may choose not to invest, regardless of how low interest rates fall. This can create a feedback loop where low investment leads to lower economic activity, which in turn reinforces pessimistic expectations, causing even less investment. You heard about the multiplier effect in the previous lecture. In summary, Keynes argued that the interest rate mechanism is unstable because it relies heavily on uncertain expectations and psychological factors that can prevent it from functioning as a reliable tool for balancing the savings and investments. After elaborating on the interest rate mechanism, let's talk about the wage mechanism. Classical economics posited that wage flexibility, falling wages in response to unemployment, would ensure that labor markets clear and full employment is restored. Keynes disagreed, arguing that the wage mechanism is flawed and contributes to economic instability in the following ways. He believed that wages are often sticky toward, or so-called wage stickiness, meaning they do not fall easily during recessions due to social, institutional and psychological factors. Workers resist wage cuts and firms are reluctant to reduce wages because it can harm morale and productivity. As a result, the labor market does not clear, leading to prolonged periods of unemployment. Hence, what is the effect on aggregated demand? If wages do fall, Keynes argued that this might not solve unemployment. Lower wages reduce workers' incomes and thus reduce the aggregated demand, the total demand for goods and services. Since businesses base production decisions on expected demand, falling wages can further depress demand, worsening the economic downturn and creating a vicious cycle of falling wages and output. And to reiterate from the previous lecture, what happens to unemployment? The failure of the wage mechanism to adjust properly leads to involuntary unemployment, where workers are willing to work at the current wage but cannot find jobs due to insufficient demand. This undermines the classical assumption that labor markets are self-correcting and highlights the need for government intervention to boost it. Thus, Keynes saw the wage mechanism as inherently unstable because wage cuts could worsen recessions by reducing demand rather than restoring employment. To sum up, due to these factors, Keynes argued that market economies do not naturally tend toward full employment, are prone to periods of underemployment equilibrium. This instability, believed, required active government intervention through fiscal policy and to a lesser extent monetary policy to stabilize the economy and maintain full employment. In the upcoming lectures, we will see how the Keynesian framework was challenged in the forthcoming decades. Stay tuned.